Something I have to remember that every time.
Oh, welcome everybody. This fortnight we thought we'd just look at 30th of June that's coming up. We've now reached 3rd of June. And so 30th of June is fast approaching. So I'm joined here today by Andrew from Financial Streams. Welcome Andrew. And so Andrew's got some information just to go through. Today we're going to look at it from a personal tax perspective. Not necessarily from a small business owner, but obviously small business owners are people as well. Mm-hmm. So there'll be some issues to address. So hopefully you can see the screen and we'll just get into it. So over to you, Andrew.
No problem. So what I've put together, Mike, is just some of the things every year that you get into June and you want to think about and see if they're appropriate for you. So I might run through just very casually what they are,
yep.
And we'll just talk about the purposes, whether that's right. I'll put a caveat in. It's always, if you're going to make any of these decisions, just sit down and talk to your advisor before you make those decisions, or your accountant, and just make sure it is right for you.
Yeah, I was chatting to Jenny the other night, my wife, and she said, "How come you're giving this information away?" You know, I said, "Well, it's just like my philosophy is that you're just sharing and people's financial literacy increases, and therefore they're making better decisions for themselves, as well as using their own advisors as well." So it's sort of the philosophy. I don't feel like we're giving away secrets. It's information that's publicly available. We just probably put it into a context. So.
So what I'll start with is just superannuation contributions going into super, and one of the Monty's of strategies that I see is really useful for people is getting money in through a concessional contribution. So what that means is that's a pre-tax contribution, and where the fund can claim a tax deduction for
the individual claims a tax deduction.
Yes.
So a couple of examples that people might be familiar with. One would be salary sacrifice, where people have gone to the employer and said, "I want to put an extra $100 a week into super or something like that."
That's right.
And I want it to come as off my gross earnings, and that's what you say pre-tax or concessional.
Yeah, that's right.
And then there's another scenario where someone gets towards this time of year, they might say, "I might put another 10 grand into super," so they make that, but then might claim that as a tax deduction in their tax return.
Yeah, so that one. So to me, the easiest one is the salary sacrifice. It's facilitated through your employer. You get the tax back pretty much straight away through the employer in your payslip. The other one is your personal deductible contributions, where you put the money in, but then you've got to acknowledge to the super fund that you're actually claiming.
Bit of mucking around.
Experience
with a couple of clients.
So there's forms you've got to get in, and you've got to get that acknowledgement before you actually rock up to the accountant to do your tax return. And I have seen some people miss out on that because of they've lodged their tax returns and haven't got the acknowledgement from the super fund. So that's one to look out for. The general cap for that is at
25,000.
Yeah.
Across the board, no age differences. It's just $25,000 per annum.
And that's made up of your super guarantee payments that your employer would pay.
Yeah, so that's 9.5%.
Correct.
Comes each fortnight or whatever your pay period is.
Each fortnight, hopefully, or the salary sacrifice amounts that you do. So if you've got any spare cash, it's a good idea to top up if you can do that. But be careful not to breach that cap, because there is consequences if you do. And it's generally just it just means that you'll have to go through a process of paying back to the tax office the tax that should have been paid. So it does get a little bit of mucking around to try to avoid that.
If you go over 25 grand.
Correct. Yeah. So there's that 25,000, and I'll just put a little bit of colour to there. With catch-up contributions, that can get a little bit higher depending on what your contributions have been in the last few years. But that's something I strongly suggest just sitting down with your your advisor or your account just to make sure that you don't.
So FY20 year, my understanding is that FY19 and 20 are the 2 years that you could do a
Catch up.
so 50 grand in total effectively.
Yeah.
For that 2 year period, and that continues for
6 years.
6 years going forward, but can't go back 6 years. So I didn't pay enough. I didn't contribute enough back in 2017 or something like that. That's only 2019 financial years and 2020 financial years.
That's right. Yeah. So you can, so you've got a little bit of time to make up around if you don't quite fully maximise that in the current year. Yeah. So the next one is the reason why you do that is it's concessional tax, and what we mean by that is it's taxed at 15% going into the super fund.
Yep.
And that's generally lower than what most people would be under their marginal tax rate as well. So that's kind of the reason why you do it. You trade off that 15% tax to your marginal tax rate.
Yeah. So just a bit of a thumbnail sketch, just so when we're talking about this from a tax planning perspective, your individual tax rates are stepped up in terms of scales. And when we say marginal tax rate, it's your tax bracket. So the first 18,000 something is tax free, the next up to 37,000 is 9%, next one up to 90,000 is 32.5%, and it keeps going up. So the average person would be in the 32.5% tax bracket. You add Medicare levy on top of that at 2%. So your 34.5% is what you pay tax for every extra dollar you earn in that tax bracket from 37 to 90,000 per annum. And so from a tax perspective, what Andrew's saying is that you're trading off, you're getting a 34.5% benefit tax-wise, but your super fund, or your super get taxed 15%.
So the difference is
9.5% better off. The trade-off is that obviously the money went to super, you can't touch till you retire effectively.
Yeah.
And so tax position, you're much better off, and it's just a matter of balancing up to say, well, I don't need those funds as part of my retirement planning. So
yeah, and so if you look at that over a collective period of time, doing that strategy, you're improving your outcome by 9.5%, plus you're getting returns in the fund over time. So if you do that as a disciplined approach over a period of time, it actually grows your super funds really quite well.
Yeah, that whole modelling that you do for clients in terms of both getting the tax benefit and that compound interest of a regular salary sacrifice arrangement does provide over a long period of time quite a significant increase in people's retirement funds.
Yes, absolutely. Yeah. So that's a great idea in my view, but just as I said, there's just double check your numbers before you start jumping in and do that, and how you're actually going to do that process, whether it's through salary sacrifice or a personal deductible contribution. The other way to contribute in is what we call a non-concessional contribution, and there's rules around that as well. And that's generally, the cap is around about 100 grand for individuals. You don't get a tax deduction for that going in, but if you think about it, the benefit is it's going into the super environment for you. So inside the fund, there is a few benefits from a tax planning perspective, which I won't cloud the subject now, but it's about the tax profile within the super fund itself. It does improve and wash out tax by making contributions in.
Yeah. I've always liked it in my head, it's effectively the earnings on that fund, effectively in a lower tax environment.
Yeah. Compared
to concessional is actually getting the tax benefit on the way in, as well as being in a low tax earnings environment.
Yeah.
Whereas the non-concessional is just, I don't know, say if your great aunt died and you got $200,000 sitting in an investment account outside of super, then you're paying you pay tax on the interest on that, as a least example, at your marginal tax rate. And if you move it into super, then you can pay that earnings on that at 15%.
At the 15%, that's right. Yeah. So the key thing to remember there is generally there's a 100 grand limit per concessional contribution.
Per annum?
Per annum.
Yep.
You can actually, and depending on your circumstances, if you've got a windfall, or if you've got a large contribution that you want to put into superannuation, you can put in more. it does trigger what's called the bring forward rule.
Yep.
And so there's rules around that. But basically, if I make it fairly straightforward, if you put 300,000 in, you can't contribute for the next 3 years. Yeah. So basically,
You
that's
can cluster 3 years together
correct.
and
Yeah.
then have a pause in the game until you've met your 3-year period.
Yeah. So, and there's reasons why you do that, from timing reasons, for basically on your overall strategy and how you're building up your retirement nest egg as well. What I put on the slide is it can allow for irregular amounts or inheritance or proceeds from
A great argument.
Yeah.
And sometimes you do see people, they might, I don't know, as they get older, might sell a holiday home or downsize so that they have a bit of extra cash.
Yeah, so downsizing got a slightly different rule around that.
Yeah, I should use that example.
We'll keep it to this today. Yeah. The other way going in, and I've just said super contributions going in, generally people who earn 10% or more of their income, employment income, can qualify for the government co-contribution, which receive up to $500, but there's rules around that as well. And most people can, even up to age 70, trigger that.
Yep.
But there is I suppose, a level where you can maximise it, and then it tapers off over a period of time.
You got that on the slide?
Yeah.
38 grand? Yeah.
So it's 38,565 to get the full benefit, and then it'll taper off.
Yep.
Until you pick, if your income's over 53,563, then you miss out on that.
So if your income is around 38 grand mark, that's not a bad option with $500 for free from the government, really.
Yeah, absolutely. So in my philosophy, it's money for jam if you can do it. But with that rule that it is locked away until
I mean, all of those rules apply. That it's these are the carrots, if you want. For doing the super strategy from a tax effectiveness or government co-contribution. And the downside of that carrot is that things are locked up in your super.
So one of the things I think about is if you've got you might have a fund that you've got life insurance attached to it. You might be in your 20s and it might be costing you a certain amount of money every year. My view is if you can trigger that, the actual government starts to pay for your insurances. So it doesn't just leave it up to you to wear that and draw down on your funds. You can actually start to get the government to pay in and pay for some of their insurance side of things. So
good idea, that one.
Good one for young people for that reason. We did have a question come through during the week about how you can get tax deductions for, I suppose, this is an offset, tax offset, but how can you...
The question was a tax deduction for making super contribution for your spouse. That was Jonathan's question.
So just to answer...
Jono.
So it does, this has been increased in the last few years. It's up to 40,000 now. So if your spouse is earning less than 40,000 and you put in up to $3,000 contribution in their name as a non-consensual contribution, you can claim a tax offset of up to $540. So it's another little win. Just to take you back from sort of the insurance funding strategy, in my head, you've got, if you're in that space with that income, you do have the ability to get funding of insurances through doing this contribution plus your government co-contributions. So if you think about it, it's giving you a nice little windfall in your hand. But with it, you've got to have the funds to be able to do so and be prepared that it'll be locked away. But if it's part of your longer term strategy and you can consider that as part of a funding mechanism, it's a good idea.
And just to clarify, you mentioned tax offset, which is an important point to note. So tax offset or tax credit or tax rebate, all very much similar terms. So that's much more valuable in dollar terms than a tax deduction. It's a tax deduction. So if I earn, I don't know, $50,000 and I've got a tax deduction of $5,000, then the tax deduction, I don't get the full $5,000 back. I only get the tax payable that would have been payable on that $5,000. So 32.5, you get about a third of that back as a tax credit, if you want, effectively. Whereas a $540 tax credit is actually no different to, so if you're being employed, that's $540 going to take out of your wage, and that's sitting there as a PAYGW credit on your tax return. So it's just effectively a deduction off the amount of tax you either pay or increase your refund by that amount.
That's right. Yeah. So the next part, I thought, well, money going out of your superannuation, which is your pension funds or your drawdown phase, and with that, it comes the minimums that you've got to draw out every year. Now, just recently, because of COVID-19, the government's announced that they've reduced that by 50% for this year. And that, in my view, that's a good idea. If you don't need to draw down on the minimum, it just means that you're not going to be drawing down on an asset at a lower value.
Yep.
Yeah. The thing to consider is every year on 1 July, you get this minimum maximum set. And, you know, if you're under the age of 65, it's 4%. If you're over 65 to 70, it's 5%. So if you think of it, that minimum is at that point, if your value is set at 1 July, the previous 12 months, then if you draw that 5% down now, right after the COVID-19, the percentage is actually going to be higher.
Yeah.
So it's a good idea, if you don't need to do that, to actually just hold off on that if you can under this.
Yeah.
But you do need to discuss that with your planner if it's suitable for you. So it does affect you, obviously, your cash flow.
Yeah.
Yeah.
And I think what we're moving from now, in industry terms, the previous slide have been talking about accumulation phase.
Yeah.
Effectively, there's 2 phases in a superannuation a life cycle. Accumulation, where you're accumulating wealth and increasing your value, and now we've moved into the pension, which is the withdrawal or pension phase.
Yeah.
And so you effectively met what they call a condition of release, which is effectively retirement, and you withdraw money out of your super.
Yeah.
And we're talking here also what the industry calls account-based pensions, loosely, which means that you have an account with that super fund, and your balances go up and down, compared to a defined benefit fund, which is no longer available, but we do have some people
still legacy ones
sitting in the system. And defined benefit was based on depending on the nature of the fund, based on certain criteria for all members, effectively, or of that subset of that group, rather than your individual account. But for our information, or our context is purely account-based pensions we're talking about, and defined-based pensions have a completely different regime.
Correct. Yeah. So I probably didn't explain that too. The broad tax structure is, if you think simply, you're paying 15% going in on superannuation, you pay 15% on your earnings, and when you get to drawdown phase, which most people find it more effective now, and in previous years you could start the drawdowns a bit earlier. But age 60 is when the real benefit is for you from a drawdown point of view.
Typically, assuming it's from what they call a tax source, then it's tax-free coming out to you down the track, because you pay the 15% on the way in. And if you're over 60 and other criteria being met, then it's tax-free income.
Correct.
If you're in a retirement phase.
If you're in a retirement phase. So that makes a lot of sense to people.
Yeah.
And there's levels of complication as well. Which, probably why
I probably oversimplified it, but that's just a generalisation.
So I just wanted to flag also this year the announcement around about the $10,000 funds that you can draw out
The COVID withdrawal
between 30 and 1 July, and you were telling me a very funny sort of thought on a Uber driver.
Oh yeah, I was just reading. I read some of the on Barefoot Investors Market, and he's just sharing a story on the weekend about his Uber driver just leaned across to him and said, "Oh, you're the barefoot guy. What do I do with this 10 grand I pulled out of super?" And sort of looked at him and said, "Well, why did you pull it out in the first place?" And he said, "Well, I thought it was better off to have it in my pocket than theirs," which is an interesting comment to make, and it's probably typical of the sort of people's impression that they still treat their super as being someone else's super and not theirs. So and I think I saw I don't know, stat on ABC the other week, and it was like I think the survey showed that a third of the people who pulled out the funds for their savings, and the comment was made, "Well, surely super is savings." So, you know, but there's sort of thing, oh, it's better to have it in my bank account, not theirs being the super funds. So.
Yeah, and I mean, I suppose the idea about superannuation is collectively over a period of time you can get a better return than what your bank savings would do. But look, pros and cons in that. If you're destitute, I understand. But if you're not, then have a chat to your advisor. Just make sure it's the right decision for you.
And I think if you met criteria, and there's a few criteria, but it's fairly loose, let's be honest. To meet the criteria. I think, I can't remember the final numbers of 1.something million people withdrawn their funds. And if you've done it once, I think you can just then apply after 1st July to get the matching funds, I think, from memory.
From after year 1 July. So just make sure it's appropriate if we do that. Be aware that you'll miss out if the market's upswinging, you miss out on those returns. So it's actually going to cost you a little bit more if you make that decision. I also wanted to talk around this year and generally around asset management. We know this year's hasn't really been the best year for investors. Been up and down, it's coming back a little bit at the moment. The
share market typically, and the Australian share market.
Australian share, but if you read that, look, there's, and I was looking at some charts this morning, and you know, there's some commentators saying that this is just we're still in a bit of a bear market, but it's just a minor upswing. So be cautious there.
And bear meaning that we could be in for a rocky road still? Still
in a rocky road, in that view. So, and we get lots of information that come through from fund managers. Everyone has a different opinion, but it seems like the general consensus is just still be a little bit cautious at the moment.
And when we talk about asset management, that's typically the breakup within your super fund balance of how much you've classified or allocated to international shares versus Australian shares and
property.
Typically, they might use the terms, say, a balance fund or a growth fund or something like that within a in industry-based super fund.
Yeah, that's right. Exactly, from that point of view. So there also can be some useful thoughts around how we can do some tax planning around that as well.
Okay.
The one thing I wanted to talk about and raise is if you've got any unrealised losses, there is opportunity now to start sitting down and planning with your planner or your accountant just to talk about those consequences.
So you're still talking about within super or even outside of super, you're thinking?
Just a general, if you're inside or outside of superannuation. Obviously, if you're in a drawdown phase, then those doesn't have such a big impact from that point of view.
And I suppose just go back to that term you use, unrealised losses, which is accountants and financial planners steal off our tongue quite easily. It's about saying, well, I bought a share for $5, it's today worth $3. You actually haven't got a loss until you come to sell that share. So at this stage, it's unrealised in terms of you've got a book loss, if you want, or a paper loss of $2 a share. And what you're saying is, do you analyse that to say, well, tax-wise, it might be beneficial to cash in my chips at the lower value, crystallise the loss, and get a tax benefit from other sources of income.
Before June. Probably better to explain than I did then, Michael.
That's all right. It's just a term you and I use quite regularly. And I look at Jenny and I go, she's got no idea what I just said.
So I might just throw this one to you around business terms.
Yeah.
Kind of your baby.
So typically you go through, people say, how do I save tax for the year? And always my response is, make sure you make money first. Don't do any actions that are purely for saving tax without a business benefit. That as a general overview caveat, there are some things, and we'll touch upon super. Super is certainly a very real tax effective strategy for businesses as well as individuals. So typically you're looking at business owners and whether they max out their 25 grand concessional contribution. Typically you've got three categories. So you've got superannuation, which is sort of a tax effective strategy because it's a low tax environment. You've got business investment. So at the moment we've got up to $150,000 for any business assets installed ready for use before 30th of June. You get 100% of that as a tax deduction in this year. Once again, go back to my earlier comments, it's a tax deduction. You don't get the full tax benefit. So if you bought a piece of gear for $30,000 and you're in a company, it's not the exact figures, but it says a third tax rate, you get $10,000 tax benefit effectively. At this stage, the government haven't announced that it will go back to what it was before the $150,000 limit, which is $30,000. And at this stage, the legislation would say it goes back to a $1,000 cap for immediate tax deduction for equipment on the 1st of July. Watch your space. Governments have a habit the last few years of adjusting that threshold, but that's what it stands at the moment. So that's a legitimate tax effective strategy. The other one is timing. So typically you may, for tax purposes, may do prepayment. So you might prepay your insurance or prepay like your IT service provider, something like that. It's got to be in cash and you're prepaying for the next 6 months and you can claim the tax deduction this year if you're a small business under 10 million turnover. What you've raised may be slightly different this year, so you really need to study your numbers because of COVID, that your taxable position has suffered this financial year. So bringing forward deductions into this year may not be in your best interest. So just be wary, a little asterisk on that this year, that some normal practices may not be. So I even had a conversation with a client yesterday talking about a vehicle, and we sort of realised that it was going to be more tax effective to claim the depreciation in future years rather than claim it now. That was a slightly different scenario, but there was sort of picks up your point that just don't follow the normal practice this year without analysing what your taxable position looks like in your business.
Income will be, could potentially be down.
Yeah.
But in saying that, we don't know how long this is going to drag out.
No, I mean, if you look at it, you know, I was picking up some stuff for the house the other day, and they do swimming pools installations. They said to me, you know, we'll bounce back because people were going over to holidays this winter and now cashing in there, getting their travel insurance refunds, and they're saying let's put a pool in the backyard. So seeing some of that kicker coming into play sort of in May and June for some businesses. Obviously, those that have been directly affected, hospitality and tourism, etc., are still in sort of a hurt mode, really. And job seekers helping them, but JobKeeper. So they're in a different position, but there are a range of general businesses, if you want, that were indirectly affected by COVID that are bouncing back. That you'd have to say, all things being equal, would have a better year in FY21 than FY20. Because, you know, going back to the swimming pool, they said, well, we did nothing for April because everyone was home, sort of thing, you know, and so there'd be a bit of catch up. But for, say, tourism hospitality places, I mean, you take a client or someone who's got some property down the East Coast to rely on international tourists. You can't see international tourists coming back for months, if not years. So they're in for a lower tax position, cash position for FY21, maybe FY22. So
and the other thing, it's a bit of that worry in the back of our minds is what happens after JobKeeper
Yeah.
winds back, what impact that has.
That's certainly the commentary around, because it's at the moment as it stands, you've got JobKeeper coming off at the end of September. You've got the bank's deferral of loan repayments coming off at the end of September. You've got the supplement for job seeker, the extra $5.50 a fortnight coming off at the end of September. There's probably a few other things I can't think off the top of my head. So there's a potential for a bit of a, everyone's sort of come off support altogether.
Yeah. Without sort of having any idea of what the government's next step would be, Michael, you would think that they must be canvassing another way to smooth that out.
Yeah. That seems to be the rational thing, and they've got another $60 or $70 billion in their back pocket. Even though it's on the credit card, they've now got up their sleeve that they didn't think they had originally. So they've got a bit of wriggle room, and I suspect it'll be industry specific, and really targeting those industries that are going to still be in pain, rather than across the board, broad brush approach, which is JobKeeper.
And I won't raise the funding that I sort of got a snippet in the paper about helping the building industry with renovations and providing. Yeah,
we might cover that up in a future session. Either one, next one, or one after.
Not to get more detail.
Just to provide a bit of a property sort of overview. I think I listened to a commentary on the weekend. They said don't underestimate the power of the government to stimulate the construction industry, because it is quite a relatively easy industry to stimulate in terms of doubling the homeowners bonus or a renovation bonus or something like that. So we'll probably cover that in a future session, I think. Just some of the commentary and analysis on property. Because we're also seeing that, the other thing coming off the end of September is the rent relief that's been in play for commercial landlords and some tenant residential. So there's some commentary starting to come out now. Some of those big shopping malls have got a bit of a black hole coming towards them. So there'll be quite some commentary on that coming up soon.
I'll tackle that next session. So generally, just to wind up on that, you've still got that ability to use the 150 per eligible asset write-off this year. But with that, as Michael's explaining, that it's not. It's a deduction. It's not
a rebate or a credit. And just a big point on the 30,000. That's what I suspect will go back to, but the legislation at the moment says we'll revert back to 1,000. On July.
So we'll wait to hear.
Wait and see what they come up with that.
That's it. I've just put a single comment here about property investors as well, just to wind up as well. Just to think about your expenses. I think in my thoughts is similar to yours around the business side of things. Do you bring forward expenses and pay things? It's just it's the same principle in my view from that.
Yeah, same, very similar principles as you said. So if you needed to replace the guttering, you better often do it in June and September from a tax perspective, with your tax deduction on that rental property in June. You still get it, but you've got to wait another 12 months. If you did it in September, you've got to wait till June 21 to get the benefit of that. So there's some timing issues there. But make sure you don't go and buy something like, I've seen people say, I don't know, put a new heat pump in there, which might have capital value, but it's really didn't increase their rental value. So it's probably marginal whether you do it now or later on. What else? There is, we might cover this on the property session as well. There is the tax depreciation write-off that is still available. It's not as good as what it was a few years back. But there's still that as well. We might cover that when we do the property update as well.
For sure.
So
lots of detail in that. So it's always a good idea just to give your accountant a call and run through that.
And similar principles to what we discussed from the business income. That if you were affected by COVID and your tenants weren't paying rent, then your taxable income might be down this year. If you deferred that rent and then you catch it up in FY21. Yeah, 21. I just had to think what year we're in. It's been a big year.
So that's all we've got really to cover today in this session. I hope it's been informative.
Yep.
If there's any questions, we will, if you can send it through to our inbox, and I've got it there. Yes, at financialstreams.com.au.
Yeah. Yep.
Any questions, any ideas or thoughts around your own personal circumstances, and you want to discuss it with either myself or Michael, we'll certainly reach out and try and assist.
Yeah, and as we've mentioned before, we'll do these Q&A sessions each fortnight. Not everyone does it live, but we've got the recording and circulate it around. I know a few people have contacted me, so they really look forward to the recording. And so next one, I think we'll do share market part 2, because we didn't finish off part 1, just looking at performance and franking credits. And then the one after that, we'll do, as we mentioned just then, a property update, both from a property investment, both direct and indirect, and returns and stuff like that.
We might have a little bit more of a snippet from what the government's thinking.
Yeah, we'll quite more stimulus on that industry. Yeah. Sure. All right.
Thank you very much.
Thanks for tuning in. And now we have the awkward
Silence.
Can't move it. Jeez, jump on the road. The left hand